Learning Goals, welcome to this learning session on trusts and estate planning. A comprehensive guide in this course we shall address estate planning fundamentals and documents, trust types, funding and administration, asset protection and tax strategies, specialized trusts and wealth transfer, incapacity, governance and succession planning. There will be a quiz at the end to test your knowledge. Foundational goals of estate planning. Estate planning serves as a roadmap for the management and distribution of an individual's assets during life and after death. Its primary goals include maintaining control over property, ensuring privacy for the family, and maximizing administrative efficiency. By establishing a clear plan, individuals can minimize the emotional and financial burden on their heirs. Understanding the probate process. Probate is the court-supervised process of authenticating a last will and testament and distributing assets to beneficiaries. Many people seek to avoid probate because it is often time-consuming, expensive, and a matter of public record. Strategies like joint ownership and beneficiary design exudations allow assets to transfer directly to heirs without court intervention. Essential estate planning documents. A comprehensive estate plan relies on several key documents that work together to protect the grantor's interests. These typically include a revocable living trust for asset management, a pour-over will to catch unassigned assets, durable powers of attorney for financial and healthcare decisions. The mechanics of trust funding. Funding. A trust is the critical process of transferring ownership of assets from an individual's name into the name of the trust. Without proper funding, the trust remains an empty vessel, and the assets may still be subject to probate upon the grantor's death. This involves retitling bank accounts, real estate deeds, and brokerage accounts to the trustee. Explore the core responsibilities and ethical obligations of fiduciaries. Understand the critical duties required when managing assets for others. A fiduciary is a person or entity entrusted with managing another's assets. They are held to the highest legal and ethical standards of conduct in this role. Trustees must strictly adhere to several key duties to ensure proper management of assets: loyalty, acting solely in the best interests of the beneficiaries; prudence, managing assets with the care and skill of a reasonable person; impartiality, treating all beneficiaries fairly and without preference. Any conflict of interest or self-dealing by a fiduciary represents a serious breach of the legal relationship. Such actions can have significant legal and financial consequences. Living versus testamentary trusts. Living trusts are created and funded during the grantor's lifetime, providing immediate management and probate avoidance. In contrast, testamentary trusts are established through a will and only come into existence after the grantor's death. Living trusts offer greater privacy and flexibility, while testamentary trusts are often simpler to set up initially. Special Needs Trust protections. Special Needs Trusts. Protections. Special Needs Trusts, SNTs, are designed to provide for a person with disabilities without disqualifying them from government assistance programs. These trusts pay for supplemental needs that public benefits like Medicaid or SSI do not cover. This ensures the beneficiary maintains a higher quality of life while preserving essential medical coverage. Spendthrift clauses and asset protection. A spendthrift clause is a provision in a trust that prevents a beneficiary from voluntarily or involuntarily transferring their interest in the trust. This protects the trust principal from the beneficiary's creditors and prevents the beneficiary's creditors and prevents the beneficiary from squandering the funds. It ensures that the grantor's intent for long-term support is honored despite external financial pressures. Selecting the right trustee. Choosing between an individual family member and a professional corporate trustee is a pivotal decision in estate planning. Family members offer personal knowledge and lower costs, but may lack financial expertise or be swayed by family dynamics. Corporate trustees provide professional investment management and impartiality, but charge higher fees for their services. Ongoing trust administration duties. Trust administration involves the day-to-day management of trust assets, including bookkeeping, tax filings, and regular reporting to beneficiaries. Trustees must keep meticulous records of all income and expenditures to demonstrate they are meeting their fiduciary obligations. Failure to provide transparent accounting can lead to legal disputes and the removal of the trustee. Managing digital assets and RUFADA. The revised Uniform Fiduciary Access to Digital Assets Act, RUFADA, provides a legal framework for fiduciary access to digital ABASE, provides a legal framework for fiduciaries to access a deceased person's digital accounts. Without explicit authorization, in estate documents, digital assets like social media, email, and cryptocurrency may become inaccessible. Modern planning must include a digital inventory and clear instructions for these intangible properties. Taxation basics for trusts are subject to specific tax rules that vary depending on whether the trust is classified as a grantor or non-grantor trust. In a grantor trust, the income is typically taxed to the grantor, while non-grantor trusts are separate tax-paying entities. Understanding the distribution of distributable net income, DNI, is essential for minimizing the overall tax burden on the trust and its beneficiaries. Wealth transfer vehicles, bypass trusts or bypass trusts, also known as a credit shelter trust, is used to maximize the estate tax exemptions of both spouses. Upon the death of the first spouse, an amount equal to the estate tax exemption is moved into the trust for the benefit of the surviving spouse. These assets bypass the surviving spouse's estate, potentially saving millions in future estate taxes. Charitable remainder and lead trust. Charitable trusts allow individuals to support their favorite causes while receiving significant tax benefits and potential income streams. A charitable remainder trust, CRT, provides income to the donor for a term, with the remainder going to charity. A charitable lead trust, CLT, does the opposite, providing immediate income to the charity for a set period. The role of life insurance trusts and irrevocable life insurance trusts, ILD, is specifically designed to own life insurance policies and remove the death benefit from the insured's taxable estate. This provides immediate liquidity to pay estate taxes or debts without forcing the sale of other assets like family businesses or real estate. The ILIT ensures that the full value of the insurance policy benefits the intended heirs. Common estate planning mistakes. Many estate plans fail because they are not regularly updated to reflect changes in the law or family circumstances. Common errors include failing to fund trusts, neglecting to update beneficiary designs on retirement accounts, and choosing inappropriate trustees. These mistakes can lead to unintended tax consequences, family conflict, and the very probate process the plan was meant to avoid. Guardianship and incapacity planning. Estate planning is not just about death. It also addresses what happens if an individual becomes incapacitated and cannot make decisions. Naming a guardian for minor children and establishing healthcare proxies are essential steps to ensure your wishes are followed. These provisions provide peace of mind that your family and your own well-being will be managed. Discover how family governance structures and succession planning preserve your legacy. Learn about frameworks for decision-making, conflict resolution, and generational transfer of assets. Family governance provides a crucial framework for families with significant assets or businesses. It establishes clear guidelines for decision-making processes and effective conflict resolution, ensuring stability and harmony within the family unit. Implementing family governance often involves several key elements. A fundamental step is the creation of a family mission statement that articulates shared values and long-term objectives. Regular family meetings are also vital for educating the next generation about their roles and responsibilities. Succession planning is integral to family governance, focusing on the seamless transition of leadership and ownership. This proactive approach is essential for preserving the family's legacy and ensuring its continued prosperity for future generations. Case study. Effective trust planning. Analyzing successful estate plans reveals the importance of clear communication and professional coordination. In this case study, a family used a combination of a revocable trust and a dynasty trust to protect assets across 3 generations. By involving their legal and financial advisors early, they avoided common pitfalls and ensured their philanthropic goals were met. Review and next steps. A comprehensive estate plan is a living document that requires periodic review and adjustment as life evolves. You should revisit your plan every 3 to 5 years or after major life events like marriage, divorce, or the birth of a child. Taking action now to formalize your wishes is the greatest gift of security you can provide for your loved one. Summary. Well done, you have completed the course Trusts and Estate Planning, a comprehensive guide you should now be familiar with. Estate planning fundamentals and documents, trust types, funding and administration, asset protection and tax strategies, specialized trusts, and wealth transfer. incapacity, governance, and succession planning. Should you need to revisit any of the topics in this course, please use the menu at the bottom of the screen.